Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back, kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Hello, Lower Alabama. Hello, Gulf Coast. Welcome to Coasting in Retirement. Thanks for joining us today. Josh Knoll here, alongside special guest co-host Payton Knoll. Payton, how you doing?
Doing good. Staying dry.
You trying?
I am trying. It's not very successful.
That's all right. Come on, but you gotta buck up. All right. Well, we're back today. Coastal College's recording studio, beautiful downtown Fairhope, ready to put on another great show for those of you tuning in. Listeners, Payton and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Here's what we've got in store. First segment, deep dive on our topic of the day. Second segment, about 30 minutes past the hour. That's headlines of the week. And then roughly 50-ish minutes past the hour, stick around for our third segment. We call it Josh's Crystal Ball and Big Mouth. Or possibly Payton's big mouth this time. Either way, buckle up. We got a lot to get to. Quick background on me for those of you new to the show. Again, my name is Josh Knoll. I am a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That is a 100% locally owned, 100% independent investment management and financial planning firm. We have offices in Fairhope, Orange Beach, and Mobile. You can find more information on me and the team at Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com, or feel free to give us a call anytime, 251-327-2124. If you just missed that contact info, grab a pen, grab a pad. We're going to repeat it several times throughout the show. Speaking of the show, Payton, I'm not sure if you heard the news, but SpaceX recently had their IPO.
I think it's the only thing on the news right now.
Okay. Yeah, so IPO, initial public offering. And what an IPO it was. I believe it's the largest in stock market history. Is that right?
Yes, it is. It's if you combine the past 19 years worth of IPOs, it's still more than those past 19 years worth of IPOs.
Oh my goodness. Well, it was so large that as of this recording, their total company valuation is over $2.6 trillion, which by my math makes it the world's fifth most valuable company by stock market valuation, right? And they achieved all of this eye-watering stock appreciation on a loss, not a profit, but a loss of $5 billion last year, 2025, on $19 billion in total revenue last year. So to give you a reference point, the reason Payton's chuckling at that, Amazon, which is the company that they just bumped down to sixth most valuable, and maybe a company some of you all have heard of, right? Amazon had $80 billion in profit last year on over $700 billion in revenue. So let me repeat that. Let me sum that up. A company that just lost $5 billion, that's SpaceX, last year, is currently more valuable than a company that made $80 billion in profit and then SpaceX only has about 1/40th of the total revenue. So that doesn't make much sense, does it?
No, it does not.
No, this math does not math. But so what we want to do with none of this making any mathematical sense and it being, like Payton said, it feels like all anybody's talking about, all right? It's kind of taking the oxygen out of the room. What we wanted to do for today's episode is to dive into whether SpaceX is worth its stock price. I'll give you all a little hint. Not really. But more importantly, the different ways that professional investors value stocks and how this will affect your overall portfolio performance. Because while SpaceX is fun to talk about, and it definitely is plastered all over the news, for actual impact on your portfolio, it's going to have some. I mean, there's some things that we're going to talk about that are unique with this IPO that are going to affect investors across the board. But more importantly, how you value your stocks, your broad basket of stocks and funds is going to have way more impact on your long-term financial health than anything that's going on with SpaceX. All right. So, are you ready, Payton?
Yes, I'm ready.
Okay. Regular listeners, you all will recognize the statement I'm about to make. The stock market is a voting machine in the short run and a weighing machine in the long run. And we'll touch on some of the things in this episode that affect stocks in the short run. Again, why did SpaceX's stock come out of the gate so overvalued? But our main focus on this episode on helping you all how to evaluate stocks and valuation is going to be on long term. While picking the next hot stock is a lot of fun, what really produces long-term sustainable success is your portfolio. In your portfolio is picking companies for the long run. So let's do this. In general, stocks are ultimately valued by a combination of a company's underlying fundamentals, i.e. its ability to generate profit and cash, and the collective market forces of supply and demand. That's really important. And with SpaceX, not to keep coming back to it, but there is a supply and demand element of that is a huge part of why the valuation has gone so high. The price you see on an exchange like the New York Stock Exchange or NASDAQ is going to reflect what buyers are willing to pay and sellers are willing to accept at any given moment. So let me jump out real quick, Payton. You are, to the newer listeners, you're my oldest son. You are attending Auburn, right?
Yes.
Yeah,
Yes, I am.
on scholarship. And tell the folks what are your majors and the stuff we're talking about. Do you talk anything about this in your various classes that you have?
So I'm currently double majoring in accounting and finance.
All right.
And everything we're about to talk from the show notes that I've read so far is exactly what we talk about in our advanced finance classes. Specifically, they love the price to earnings ratio, which we'll talk about in a second, and how to value companies. And we actually had to give it a whole presentation on IPO. That was our whole AI semester-long project, was about IPOs and mergers and acquisitions.
Was initial public offerings, right?
Initial public offerings.
Yeah, and so for those of y'all that are not stock market nerds like we are, are not going to college for this like Payton is, initial public offering is when a private company issues their shares to be publicly traded on a public exchange. Again, New York Stock Exchange, NASDAQ, whatever it may be. And what happens at that point is if you're an early investor in that company, like we'll use SpaceX as the example, you hold shares of that company. You could hold 1,000 shares, 1,000,000 shares, whatever you've got. When they go public, you've got the ability now, as opposed to just buying and selling those shares in a private transaction, now you're opening it up to the bigger, broader retail, regular investor. Anybody can go and buy stock on the exchanges. So you're opening it up. And what you're hoping is that you got in early on this company, and I'm sure some of these investors got in very early at a very low stock price. You're hoping if you're assigned to sell at that point that you're making a significant pop on the initial public offering, right? And then Payton mentioned it, the PE ratio, the price to earnings ratio. So what we're going to do, what Payton's referring to is all stocks, all companies have some form of intrinsic value. That is historically how professional stock pickers would look at the stock market. Now, of course, remember what I said at the beginning, that the stock market is a voting machine and a weighing machine in the long run. Intrinsic value doesn't always have a whole lot of impact on a stock's value in any particular moment in the short run. We're looking, again, as Payton said, we're looking at how do you value these things for the long run. So we're going to start with a couple different ratios on how to evaluate the price of a stock. All right, so let's start with the price to earnings ratio, what's commonly referred to as a PE ratio, which is the most common ratio metric. And like you said, Payton, one that your professors like to reference a lot.
Definitely, yes.
Yeah, the basics of it is you're going to divide the current stock price by the company's earnings per share. That's going to tell you how much an investor is willing to pay for every $1 of earnings, right? And so what it means is if you've got a lower PE ratio, that sometimes will imply that a stock is quote unquote cheaper or maybe a value stock, while a higher PE ratio means that investors are willing to pay a premium for future growth. Here's a little hint. SpaceX's PE ratio is off the charts. So for example, just basic math, if a company's stock trades at $100 and it makes $5 per share in profit, take that 100 divided by that 5, you now have a PE ratio of 20. Or in other words, you're paying $20 of share price for every $1 of current earnings. That makes sense?
Yes, and in our class, they use it more as a comparison between companies, so in the same industry. So if you see a company that has a really low PE ratio compared to its competitors, it's an undervalued company, versus if it's a really high one and everyone else is pretty low, it's an overvalued company.
Well, that's a great point, because the PE ratio is not going to be consistent across the various sectors in the stock market. What is an acceptable PE ratio in retail, like Walmart, would not be an acceptable PE ratio comparison to a company like SpaceX or
the
any
tech should have a lot higher than the retail.
Bingo, that's right. But you do have to, one of the things that that people have to pay attention on the PE ratio is it's got a couple flaws. It's based on, for one, you're getting that earnings number based on the accounting provided by the company. Well, sometimes they could be doing different accounting tricks with that. They could have non-cash expenses. They could have different corporate tax structures. Sometimes companies will manipulate, and I'm saying not in a nefarious or illegal way, but they will manipulate the numbers to achieve a certain earnings, if you will. For example, Payton just mentioned it, but tech companies and the PE ratios, a lot of times if they do have some positive cash flow, they are dumping that back into the company as opposed to paying out any dividends because they're banking on future growth, right? The other thing too is, and again, Payton alluded to this, just because a low PE ratio in a particular segment and may signal to you that it's a cheap stock, you got to pay attention because sometimes a stock is cheap for a reason. It means that the underlying business is structurally dying, right? That, you study media a lot, Payton. The traditional broadcast media, is it growing or is it shrinking?
It's shrinking.
Right.
I mean, the specific deals like NFL and sports deals are growing, but everything else is shrinking.
That's right. All right, we got a couple more ratios that are maybe not as common. The price to sales ratio, or the PS ratio, that's where you divide a company's market cap by its total revenue. So this is going to be something that's heavily used for startups or companies that are not yet profitable. So let's use SpaceX again. Their price to sales ratio is around 100x. All right?
Jeez.
I want to repeat that, y'all. And you have no reference point, but I'm about to give you one. The price to sales ratio on SpaceX right now is over 100x. The rest of the S&P 500 has a price to sales ratio of around 3.5x.
Jeez.
It's that out of whack, right? And then lastly on our ratios, there's the price to book ratio. That's where you're comparing a stock price to the company's quote-unquote book value. That's its actual assets minus any liabilities. This is something that Warren Buffett would have made famous, and we're going to talk more about him later in this segment. It's widely used for asset-heavy businesses like banks or insurance companies, kind of your more stable, steady Eddie stuff, if you will. All right, any questions on those ratios, Payton?
No, those are ones we use in class.
That's great. So price to earnings, which is the one that most people have heard of, price to sales, and price to book. And those are, again, for those of you all just now tuning in, these are ways that you can actually look at the valuation of an individual stock. And we're also using this to compare and contrast what is going on with the one stock that is dominating the news right now, and that's SpaceX, just to kind of show you how it is really more or less breaking all the rules around these ratios. We'll see how long it can continue to break those rules. But moving on, the next one that for valuing your stocks is, and I'm curious on this one, Payton, is called discounted cash flow, or DCF. Is that anything that you're dealing with?
Yes, we get a calculator for it though.
Okay, you get a calculator.
We don't get the formula. We don't have to worry about the formula. They give you the calculator and you plug all the stuff in.
So you're saying in the old days when I was in college and I had to get out a piece of stone tablet and a hammer and a chisel and figure this stuff out by hand, you now have a calculator that just does it for you.
For my finance classes. Now for my accounting classes, they give us an old school table where we have to take the time with the percentages and figure out if it's an annuity or an ordinary annuity or annuity due, and then you have to work back from there.
Very good.
So the accounting classes are more issues.
Well, so discounted cash flow, the math to get there is fairly complex. That's why they have a calculator for it, but the understanding's fairly basic. A business is worth exactly the sum of all of its free cash flow it will generate from now until, Judgment Day, discounted back in today's dollars.
Right, and because a dollar is worth less than a dollar today due to inflation and opportunity costs, if you add up all those discounted future dollars and divide it by the total number of shares, you get the fair value. If that number is higher than the current stock price, the stock is technically undervalued.
Okay, and like you just said, because a dollar tomorrow is worth less than a dollar today. Inflation.
Inflation.
Right. Well, the problem, the one of the problems with the discounted cash flow model is that, as you can imagine, no one knows exactly what a dollar is going to be worth tomorrow. We talked, I don't know if you listened of course you listened to the last episode, but for you all that heard our last episode, when I was born, there was around $1 trillion in our United States government economy. Now there's over $23 trillion. My guess is in 1975, when they were looking at discounted cash flow, that there's no way they devalued the dollar that strongly, right?
No, they did not.
So it's kind of hard. So the point being is the DCF model is based on assumptions. And what happens is if you can tweak the projected growth rate or adjust your inflation rate or your discount or your dollar devaluing, you could look at a really rapid swing and differences in what is considered fair value. So it's kind of garbage in, garbage out. Very good. All right. And then next, we're putting math to the side. And again, back to SpaceX, the supply and demand and market psychology. So while fundamental math, the ratios, PE ratios, dollar cost, all that, they dictate the long-term true value of a stock. Daily price swings, as any of y'all that invest know, are often dictated purely by supply and demand and by investor sentiment and speculation, right? So that is why this stuff, that everything we're talking about here, these are for long-term valuations. If you were to apply these in the moment, forget SpaceX. If you were to apply a lot of these ratios to some of the more rapidly appreciating stocks that we've had over the last 6 to 12 months, even their ratios are going to be pretty wildly off, right?
Yeah.
It's a fun exercise for those y'all that really want to dive in understanding what your stocks are worth. Just pick a couple and take a look at it. Some of them will surprise you that they're actually pretty accurate for the historical values long term in their sector, but some of them are going to be so out of whack one way or the other. It'd be a good exercise to see where you stand. All right. And we just mentioned him. We mentioned Warren Buffett, right? So people often look to Buffett's style of investing as kind of the benchmark. And that makes sense. He's had a very long history of success in stock market and company ownerships. Do you all talk about Warren Buffett, or is he kind of aged out of the college conversation?
He's kind of aged out of the college conversation. I mean, I still reference him whenever you read the news and stuff, but I don't think I've seen a single other person in my class ever mention Warren Buffett.
Well, I wonder if there's anybody going to be the next Warren Buffett. That's a conversation for another show, but the thing that was unique about Buffett, not only did he do this out of Omaha, right? He didn't do it off Wall Street or California, but his way he communicated, and the fact that he always held to the thing that I'm only going to invest in what I understand. And he was one of the first ones that came along that kind of really popularized looking at the stripping down a company, putting all the emotion to the aside, and looking at what is this company actually truly worth. And by doing so, he was able to identify a lot of things that he felt were undervalued, that were not getting attention, i.e. Berkshire Hathaway. I don't know if you know this, but that started out as, I think, like a reinsurance company. Oh. And now it's a huge conglomerate that he bought for pennies on the dollar because he looked at the cash flow. One of the other things he looked at, and this is a ratio we haven't talked about yet, I'm curious to see if Payton is familiar with this one. It's called return on equity. So Buffett will, and I'm using the past tense because I just don't think he is heavily involved as much anymore.
He's like 96 years old.
Well, I mean, some of our listeners are 96 years old. It doesn't mean that he's not valid.
I mean, I'm hoping he's enjoying his retirement.
Yeah, we'll see. To me, he seems like a guy that never stops. But my point being is, he would target a high and sustained return on equity. What that means is that the company is getting profits and revenue off of equity that they have, not borrowed money, their debt to equity ratio. Because a lot of the companies that, especially AI companies that are coming up like OpenAI and Anthropic, these are heavily leveraged companies, right? Whereas Buffett would be looking more at, he was famous for going way in on Coca-Cola when Coca-Cola was down. And that's one of the ones that played out for him well. He also looks at owners' earnings. So what that is, that's net income plus depreciation, and a word that I cannot say.
Amortization.
Thank you. Yeah, it's more than 3 syllables. Michelle's not here to help me. Minus the capital expenditures. That is a bunch of gobbledygook for those of y'all that are looking in. What he's actually doing, again, is he is stripping away some of the accounting tricks, the depreciation, the things. Because any of y'all business owners that are listening, you know that you've used depreciation in a lot of years to help with your bottom line tax bill, especially some of y'all that, hey, oh shoot, I got to go buy a piece of equipment, or, I got to buy some type of vehicle, and I'm going to go ahead and depreciate that fully now to help with my current tax situation because I had a solid financial year. Buffett would strip away all of that stuff to get to the baseline number, the owner earnings.
Otherwise known as free cash flow.
There you go. Thank you. That's exactly where I was going. You beat me to the punch. Otherwise known as free cash flow. And he kind of, honestly, free cash flow was a thing that people knew, but he's the one that made it famous.
We have to do that in all of our classes.
I love it.
Calculate free cash flow.
I would say that you have to do that primarily because of Warren Buffett's influence, but I might be giving him too much credit. All right, so all these ratios, all this stuff that we're talking about, how do we pick stocks and funds at Gulf Coast Financial Advisors, right? So let's talk about that as we're starting to close this segment out. The first thing you need to all understand is that we look at yield plus growth. That's kind of dictate how we think about any stock, any asset class, any fund, anything. What do those different pieces mean? So let's start with yield. Yield is the income or the dividends paid on a stock. So simply put, this is the money that appears in your account regardless of the market's performance that day, week, or month. That is a company that is making money and possibly sharing those profits in the form of dividends. Make sense? Okay. Earnings growth, that's the engine of the company's profitability. As companies grow their profits over time, their stock price tends to follow. The most durable component of their valuation is this earnings growth because it's tied to the real economy. Is the company innovating? Are they getting more productive? Are their services and offerings growing in their segment that they're trying to grow? All right. And then the last thing is valuation change. So we got yield, earnings growth, and valuation change. These are how we evaluate our different stock and fund picks. This is the sentiment of markets, and this is actually what makes the news in your daily feed. When they talk about SpaceX, Payton, I don't know. Only the nerds are talking about what the true value of it is and all that stuff. Most people are talking about, oh my gosh, it went from 135 a share to whatever the heck it's at now, 200?
It went down to 182 this morning.
Oh, it did? Okay, all right. Well,
so it's still going up.
It's bouncing around. The point of it is the valuation change is what gets all the headlines, but surprise, it also has the least impact on your stock market portfolio over a long period. Let me repeat that. The majority of the stock market news that people like Kramer throw at you is the least important part of how you pick a stock. You don't believe me? Let's go through the math. Are you ready, Payton?
Yes.
Let's do some math here. So I don't want us to do every single decade.
He's really excited. He really wants to do every single decade.
I love this chart. Let's just start. We'll go back to the 1900s. In the 1900s, the overall stock market produced a yield, which again was profit, income, dividends, of 3.9%. It had earnings growth of 4.7%, and it had valuation change of right under 1%. So if you add those three numbers up, you get annual return in the 1900s on the stock market of 9.5%. Does that make sense?
Yes, I've seen this chart before in class.
Okay, have you?
Yes.
All right, then walk us through the 1930s. Walk us through the Great Depression.
Oh, so we have the yield of 3.1%.
Yep.
But the earnings growth went down 5.7%. The valuation change still went up a little bit, 1.6%, but overall annual returns for all the 1930s was down 1%.
This is so important, folks. The valuation change was positive during the Great Depression. Mm-hmm. All right? Remember that. That's really important. All right? Let's go to the 1970s, which a lot of listeners will listen to or will remember. The yield in the 1970s was 3.4%. The earnings growth was 4.4%. And the valuation change was 8.6%, producing, everybody remembers?
You jumped around.
I jumped because I can't see anything. The valuation change was negative 8%, which goes with what most people would remember. But what most people remember is the stock market ended the decade on a positive note with a total return of 5.3%. All right? Now, Payton, jump us to the next 5 decades. There's one runt in the litter, but give us a broad outline of what's happened since it was 1980s all the way to today. What's happened with all this stuff?
What are you saying? I'm saying
the annual returns.
Everything?
Give us the annual returns.
Annual returns.
Yeah.
So after 1980s was 16.4%. 1990s was 17.6%. The only down decade we had was the 2000s, which I think partnered with the dot-com bust, 9/11, 2008 financial crisis. That went down negative 0.8%.
Yep.
And then the 2010s and so far the 2020s have both had 15% annual returns each.
All right. So to sum this up on that chart, here's the really interesting thing. And folks, we'll have this on our transcript if you want to see the numbers, what we're talking about. If you look at the last century of the stock market, it has returned correct me if I'm wrong, Payton, 9.8%.
That's the average.
That's the average. Well, that's the average annual return over the last 100 years. Of that 8.8%, 3.1% of it was yield, company income and revenue and profit, right? 5.2 was earnings growth, and only 1.5 of that, almost 10%, was valuation change. But it's valuation change that gets all the news, right?
Mm-hmm.
So what do you think of that? I mean, I think that's a real eye-opener. The math is math.
Valuation change is better PR than the rest of them.
Right? Isn't that crazy? And what they should be talking about is the earnings growth. Because what most people don't realize is profit margins. If you look at United States publicly traded companies are actually becoming more efficient at producing profits. It is up, and Payne, you'll have to help me there. It says the S&P 500 profit has exploded up to 16.7% in current, right? And that is, compared to years ago, this chart's way too small for my ancient eyes, but it is way higher than it used to be. So what to sum that up, to get back to talking to plain English to you all, what that means is, again, to reiterate, when you're looking at evaluating the price of a stock, you have all these ratios to help you. And, if you're fortunate enough like Payton to go to a great university like Auburn where they can teach you the nitty-gritty, and I really appreciate and respect the fact that they're making you manually calculate some of that stuff. That's fantastic. If you have the ability to do all that stuff, that's great, right? A lot of times you're just kind of relying on what your investment advisor tells you, or what your trading your trading platform tells you, or the news, or social media, or anything like that. What we're telling you is, even if you are not somebody that wants to go to the trouble of calculating any of these ratios, or the dollar, the future value, free cash flow, all that stuff, the one thing that you need to kind of tune out is all the noise around the valuation change, because that has it does have an impact, but it has the least impact on your overall portfolio performance. What you're really looking for is the earnings growth and the yield. Make sense? Yep. Lastly, add to that, what you're really looking for is the multiple of earnings. Investors will tend to pay up for growth, which is what you see when you have multiples higher for earnings that are growing or have the potential to grow. So all this said, Payton listeners, it may surprise some of y'all that while we do at Gulf Coast Financial Advisors, we hold stocks in a lot of our investors' portfolios, we aren't necessarily huge on stock picking overall. We prefer to own the beta, or again, in plain English, we don't constantly hunt for the needle in the haystack. We just buy the haystack. That's because for most of you investors, portfolio improvement will happen at the allocation level, not in picking the individual security right. It's wonderful to pick the next hot big thing, but as often as picking the next hot stock, more often than not, you're picking the next dog, right? The more important thing is to get your allocations right. That is, don't be afraid of being invested in equities with your long-term portfolio. And more importantly, stop letting salespeople and online knuckleheads scare you away from the stock market. If you get your asset allocation right, the rest of your financial plan will fall into place. Very good. Any questions on any of that, Payton? We went a little long.
I know we did a little long, but
that's right.
It seems pretty plain English to me.
Plain English, very good. All right, well, listeners, if you want to set a follow-up conversation with the team here at Gulf Coast Financial Advisors, it's very easy. You can catch us at 251-327-2124, or find us on the website. That's gulfcoastfa.com. FA is in financialadvisor.com. On the site, there is a blue button in the upper right-hand corner that will put that'll put something on my calendar. You can do one of three choices. It can be a 15-minute introductory phone call. It can be a 30-minute Zoom, or our preference, let's meet in person. We have 3 office locations. We're in downtown Fairhope in the Portico development. We're in Orange Beach, which is just down the road from the wharf. Or we have a third office in Mobile. It's near the intersection of Dauphin Street and I-65. However you reach out to us, please do. We would love to meet with you. All right, folks, coming up next, there's always a lot going on in the world, particularly the world of finance, investments, and money. Every week, we scour the internet for financial articles relevant to those of you in or near retirement. Then we give you our honest opinion about these headlines. So join us after the break to hear Payton and I discuss this week's relevant news in our Headlines of the Week segment. Stay tuned.
A multidimensional financial services company, Providence Partners serves the needs of independent insurance, financial, and employee benefit professionals. The team at Providence Partners serves other business professionals like property and casualty agencies, registered investment advisors, community banks, and benefit brokers to assist in their clients' risk management planning. Whether an individual or business owner client, this planning includes income replacement protection, planning for extended healthcare costs, family needs, and generational transfers of wealth. At Providence Partners, we give you access to industry specialists. Those specialists focus on business succession, business owner planning, family and household protection, estate planning, planning for that income loss, or planning for long-term care solutions. Providence Partners is an Alabama-based company. We have offices in Birmingham and along the Gulf Coast. Our website is providencepartners.org, and you can reach us any of the working days.
Welcome back to Coasting in Retirement. Your host Josh Null here, alongside co-host and my son Payton Null. So as we discussed before the break, every week we scour the internet for financial articles that pertain to those of you in or near retirement. Our job, or at least we tell ourselves it is to help you all understand how these headlines impact you, especially when it comes to your money. Now, quick note, if you want to read our referenced articles, we include them on our show transcript. We include the hyperlinks, which you can find on our website, gulfcoastfa.com. Just go to the podcast tab, go to the episode you want to re-listen to, and you will find the transcript and all the hyperlinks there. But with all that said, without further ado, here's Payton with the headlines of the week.
All right, Josh, our first headline this week comes from Newsweek.
Josh, I'm Dad.
Oh, and it touches on a massive trend that hits right at the intersection of the tech boom and personal wealth. It's titled, How Data Centers Are Set to Impact the Value of Your Home. With artificial intelligence expanding exponentially in 2026, tech giants are racing to build massive, hyperscale data centers all across the country. Historically, homeowners have fought these projects, fearing that the industrial noise, towering power lines, and sheer size of the buildings would destroy their local property values. But the article highlights a surprising new study out of George Mason University that analyzed Data Center Alley in Northern Virginia. It found that homes closer to these data centers actually sold for higher prices on average, not lower. The researchers point out that data centers naturally gravitate towards areas that already have top-tier infrastructure, reliable power grids, and fiber connectivity, the exact same features that home buyers value. Plus, these massive facilities generate huge amounts of local commercial tax revenue, which has actually driven down residential property tax rates in some counties by nearly 40% over the last decade.
I don't know if I believe that stat.
I don't know if I believe that either. But while the macro real estate data looks positive on paper, this piece also quotes local community advocates who warn about the hidden long-term trade-offs, like heavy strain on the local power grid, the physical transformation of rural landscapes, and sudden rezoning battles. From a retirement planning perspective, your home is often a client's largest liquid asset. When a community transitions into a digital infrastructure hub, how should retirees weigh the financial benefit of a lower tax bill against the actual quality of life risks of living next to the physical cloud?
All right, son. I'm Dad, not Josh.
Okay.
Yeah, you're like your brother's friends all call me Mr. Josh. So when I first read this article, my immediate reaction was like, I don't know about this math, right? And I believe, I should have had this in our show prep, but wasn't it Pritchard declined approving an AI data center? Somewhere in the region just recently shut one down, right? Mm-hmm. And I get it, because a study showing that property values go up when a huge, massive, buzzing industrial server farm moves next door. That seems like some Wall Street spin to me.
It definitely does.
We haven't dealt with it yet, but I'm dubious of that. So let's look at the actual reality on the ground. These hyperscale data centers are essentially heavy industrial manufacturing plants is what they are. They do require massive cooling towers, and I know there's been a lot of conversation around them running their own internal cooling now, right? Mm. But I still think they need some type of very filtered water.
Yeah, they're still connected to the water supply.
Still connected to the water supply. And I do know they generate a constant low-frequency hum. There's been reports in Virginia and Ohio, whatnot, that kind of drives people crazy.
It would drive me insane.
You're right. And then, of course, you got the high security fence, the barbed wire, the diesel generator backups. My guess is, if you're suggesting a home buyer is going to pay a premium to stare at all this, I don't know if I buy it, right? Now, the other side of the argument that will be made is it creates jobs in the construction of it, right? And I don't know enough about the individual construction to say how much that impacts anything or not, but it's always good when we're building things, right? The other thing is, I do think that from what I have seen, your article states that it's going into areas that already have pretty good utilities, and that's probably true. But it seems like a lot of the ones that are making the news are going to areas where maybe there's some economically depressed areas, and they're using it as like, hey, we're here to help provide construction jobs and be a good neighbor and all that kind of stuff, right?
Right.
All right. Okay. My biggest heartburn with them is how long Payne, one of I guess the benefits of being on Earth for 5+ decades is you've gotten to see the cycles of certain things, and some of the things that I thought were permanent as a kid, I've been on Earth long enough to see those things become completely irrelevant. For example, when I was your age, a little bit younger, there was nothing probably more thrilling than going to an enclosed mall, right? To go walking around, of course, a little bit younger, teeny bopper, if you will. But you'd go to an enclosed mall. You had all these wonderful stores. You had Sharper Image. You'd have like a Venture department store on one end. You'd have a Sears on the other. Montgomery Ward. I'm really going back in time here, but you have all this cool stuff to walk around and see, and you see your friends and all that. When's the last time you've been in an enclosed mall?
Maybe. Oh, last summer I was in Denver. I went to an enclosed mall.
Why, to go to a Lego store?
Yeah, to go to a Lego store.
And then you didn't go walk around and look at the other stores.
No,
you
I
went
left
in,
after 10 minutes.
So my point being is I've been around long enough to see some of these things that you thought were always going to be useful and vibrant to become completely irrelevant. How long do you think it's going to be till these data centers become irrelevant?
I don't know. I think as we continue to increase our technological development, that they should be getting smaller and smaller and smaller, not bigger and bigger and bigger.
Well, the one they're doing in Utah or wherever it is like 40,000. I mean, it's a
one
monster.
In Arizona?
It's bigger than Manhattan.
Is that the Mr. Wonderful one?
Yes, thank you, Mr. Wonderful, right. So my point being is the argument is not only are they getting better at being a good neighbor, also the big overall argument is, hey, we don't want China to win, right?
Yeah.
That's the big thing.
What they've been saying.
So it's a complicated question. I'm really dubious that it actually lowers property taxes and utility rates. I'd have to do more research on that. And I'm extremely dubious that it actually improves profit value, because that's like saying, hey, I'm going to build a John Deere manufacturing plant next to a neighborhood, and it's going to make your house prices go up. It might help you with job creation, and that's nice, but I don't think it's going to make your home value go up. So all that is a long-winded way of saying I'm usually on the side of cheering on progress and technology and advancements and all that. But in this particular thing, I think they've been heavy-handed, and I think they've overplayed their hand.
Oh, most definitely.
And now they've got all kinds of problems on the pushback, right?
It's become a bipartisan issue.
It has. It has become a bipartisan issue. That's right, across all political spectrums. You can't pat people on the head and tell them that you know better than they do when you haven't even been to where the people have lived there for years. And you're like, hey, just trust us. You don't want China to win this thing. They don't care. They just don't want this monster thing next to their house. All right, what's next?
All right, our second headline brings us right back to our core theme today of how companies are priced versus what they're actually worth. This one from the Motley Fool, and it is a massive story, and it's titled Space X climbed nearly 20% in its first day of trading.
It hasn't stopped since then.
No, it hasn't stopped. So the highly anticipated debut finally happened, and retail investors absolutely flooded the gates, opening at that $135 of institutional pricing we mentioned earlier, although my friend bought in, and when he tried to buy it as soon as it went on sale, it was like 150.
Right.
So it spiked immediately.
There was a lot of trading platform problems right off the bat. Yes.
I know Robinhood crashed.
Yes.
So retail demand immediately sent the ticker flying, closing out day one up nearly 20% at around $161 a share. This initial pop has pushed the company's market cap well past the $2 trillion mark, officially making it one of the most valuable corporations on the planet overnight. The article pointing this out also gives a heavy dose of caution. It notes that this day one surge was driven almost entirely by retail FOMO, fear of missing out. It wasn't fear of looking. It might have also been fear of looking old.
Yeah, fear of looking old. FOLO. I coined
his
that
favorite.
one.
And heavy momentum trading, rather than anyone sitting down to look at the underlying financial ledger. The piece warns that at a $2 trillion valuation, the market is completely ignoring the massive capital expenditures requiring to keep launching rockets and exploding them sometimes, the reality of satellite degradation cycles, and the fact that its valuation metrics are now trading at multiples that make even the priciest tech stocks look cheap. Tying this into what we discussed in our first segment, with the price going up 20% on the first day of trading, but the intrinsic value of the actual business not changing a single bit between 9:30 a.m. and 4 p.m., how do you use the valuation tools to discuss SpaceX with your clients?
Well, the main thing I discussed, we're staying away from it, to be honest with you. And my clients trust me enough to know that we're in this for the long term. If you could have bought that initial IPO and immediately turned around and sold it, that'd be great. But they were doing this, again, some of the things that they did are very unique to this IPO. They were doing certain lockup periods on retail investors, which is not typical, right?
Is it 30 days?
I don't know off the top of my head, but they're doing lockup provisions. So the problem with that, y'all, is when these lockup provisions start to go away, you're going to see a massive amount of reselling of these positions, which means that if you're holding this thing, if you're kind of doing it as a day trader, or even really what it is right now, it's kind of a meme stock to some degree. It's a meme stock with some meat on the bone, but it still functions and looks and smells and tastes a lot like a meme stock. If you're doing it as a day trader or to have some fun with it, that's fine. But if you're doing long-term investing, this thing, we're wanting to hold this position for 6 months, a year, 2 years, 5 years, whatever it may be. It's going to take so long for the underlying fundamentals of SpaceX's business to catch up with its stock price, right? And remember, I've said this now, this will be the third time. The stock market is a voting machine in the short run. It is a weighing machine in the long run. There has been one person in the history of the modern stock market that has been able to elevate above that gravity, and that is Elon Musk. So this is going to be a real test, and that's not a judgment. I'm saying that out of respect. Tesla, the car manufacturing company, is by any metric wildly overvalued, right? It's worth more than Ford, GM, and all the other companies put together. That doesn't make a lick of sense when it sells a fraction of the cars they sell. So this will come down to, is his sleight of hand, is his future of having data centers in outer space or at least orbiting the Earth, is colonizing Mars, is all the robotics, the built-in AI, the components of this, Starlink, which is probably the most promising piece in the short run of all this stuff. If he can keep those balls in the air, then maybe this thing will eventually grow into its valuation. But to me, the stock market is always forward-looking. To me, it's looked too far forward in this particular example. So it's going to be interesting to see how that plays out. Obviously, that kind of bleeds into a little bit of our crystal ball part of this show too. But I think for now, we just told our clients, hey, you're welcome to jump in this on your own. Let us know how it goes. But an IPO, this is really not necessarily a traditional IPO. This is more of, we know that there is this huge amount of pent-up demand, and we are going to release an extremely limited supply just to see how far can we push the valuation right off the bat. Because last piece on that, Payton, I don't know if you knew this or not, but usually you're required to release 10% of your total shares, outstanding shares on your IPO. Did you know that?
Yes, I did know that.
And they got the exception only to do 5.
Oh, really?
Yes. Yeah. So they have all kinds of exceptions. We'll see how it plays out. All right. Well, I think that's all the time we got because we ran a little long in that first segment, right? So let's get the listeners. We're moving on to segment 3. Listeners, if you want to set up a follow-up conversation with the team here at Gulf Coast Financial Advisors, give us a call, 251-327-2124, or find us on the website. That's gulfcoastfa.com. FA is a financial advisor. On the site, there is a blue button in the upper right-hand corner that will put a meeting on my calendar, 15-minute phone call, 30-minute Zoom, or again, our preference, let's meet in person. Any of our 3 office locations. We're in downtown Fairhope. We got an office off a canal in Orange Beach, just down the road from the wharf. And then we've got an office in Mobile near the intersection of Dolphin Street and I-65. But however you reach out to us, make sure you do. There's no cost. There's no obligation. We're gonna talk just like we're talking here on the radio, and we're going to see if we can leave you better than we found you. All right, folks, coming up next, Josh's crystal ball and big mouth would have been some of my predictions, would have been some of Payton's predictions. Was he right? Was he wrong? And we're going to find out. What do we think is going to affect investors in the near future, or maybe even the distant future? We talk about all these things, poke a little fun at our big mouths. Stay tuned. Whether it's building a business from scratch with your own 2 hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's Gulf, like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back. Your host, Josh Null here, joined by co-host Payton Null. So I'm opinionated. I have strong opinions at times. I've always argued that a radio show host that doesn't have an opinion would be very dull to listen to. And of course, I'm paid in my profession to offer professional guidance and opinions to my clients. So the main thing is, if I don't have anything intelligent to say, you can just replace me with AI, which we've talked a lot about today. I like making predictions. Payton likes making predictions. Sometimes we hit the bullseye. Sometimes we swing a miss. So we're going to first, is there a little crow to eat? Yes, there is. We're going to start with Josh's crystal ball and big mouth with Payton. So I'm going to tee you up, son. I don't remember what episode it was. It's been a few months back.
Are we raising a generation of gamblers?
Are we raising a generation of gamblers, which was a great episode. You all should find in our back catalog on Spotify on our website. But on there, this was before the deal was totally put, well, let me rephrase that. This was back when both Netflix and Paramount were pursuing Warner Brothers. And at the time, Payton predicted that Netflix, he was so certain of it, was going to be the winner of it. Now, I'm going to give you a little bit of leeway here, a little bit of noose. I'm not 100% sure this deal's done yet.
Oh, I'm about to talk about this.
But so as of right now today, Paramount is the one that is trying to get approval for buying Warner Brothers. But you got more to say. So that part you were wrong as of today. But tell us what's happening moving forward.
So he's trying to make me eat some crow, but I am not entirely wrong. So when I made the prediction last time, Netflix came in, offered an appropriate amount of money to buy Warner Brothers. Paramount went behind them and offered 10 times basically what Netflix was willing to pay, vastly overpaying for Warner Brothers. So it looked like Paramount had swung in and won the deal. But recently, it did leak that the DOJ apparently approved the Paramount Warner Brothers merger. That happened last week, but they have not announced it yet, which I find weird.
Well, what they leaked was they just declined to investigate further.
They declined to investigate further
because it's FTC that's actually got to.
Yes, on the federal level.
Yep.
But then it also came out this past week that California and New York, among other states, are all planning to sue the merger itself.
Yeah, generally speaking, your more liberal states, their attorney generals are probably lining up to go after this.
Yes.
Okay.
And Paramount has also now alleged that Netflix is lobbying behind the scenes to make sure that they go after this merger.
I would believe that. Yeah.
So I'm not fully changing my prediction.
Well, here's one area I can help you on your prediction, because this ties this issue into our overall theme of the conversation. You mentioned that Paramount went way above and beyond the Netflix bid, right?
Yes.
They did this by incurring debt. So they have put together a deal that's got somewhere to the tune of $80 billion in debt.
Yeah, and 49% of it is from like Saudi Arabia and countries in the Middle East.
And that's fine, wherever they get it from. The point being is, this is a deal, again, back to tying this whole episode together, Warren Buffett wouldn't touch this thing with a 100-foot pole.
No.
Right?
Their debt rating's going to go down to low Bs.
They have got to take this company and do some things with it that have never been done with the profitability of these companies, even in their heyday, just to service the debt on this company. So it's going to be curious. The point of what I'm trying to say is, Payton, is even if you end up being wrong and Paramount wins this, I'm not sure that they win in the long run.
No.
I think I don't know if you know this, but the worst mergers in purchases in stock market history almost always have something to do with Warner Brothers. I don't know if you knew that.
Yes, every company that's bought
AOL,
them has lost.
Time, it's been a dog the whole way through.
AT&T, they lost so much money. Discovery might be the only company that wins in this scenario, and those old AT&T investors. But I am still keeping my prediction. I may be exhibiting sunk cost fallacy here, but I say that even if it does go through a Paramount, Netflix will still swoop in there whenever they default on all their debt. Or this gets blocked and Netflix ends up taking it anyways.
Payton is saying that what happens with these companies is the debt can be defaulted and it can be sold in the market, and a lot of times competitors will buy that debt and then they'll call it.
Yep.
Oh man, that's juicy. All right,
That's my prediction.
Well, that makes mine's boring. Yeah. Here's my prediction. Again, tying in, putting some stitches in this AI conversation. There's all of these, AI is going to replace all of us, right? That's what they're saying. But they're particularly picking on quote unquote middle managers, which no one has. I've never seen somebody with a business card that said, hey, I'm head of middle management. But there is, if you estimate, according to Google anyway, there's roughly 16 to 20 million middle managers in the United States, which is, again, according to Google and the Harvard Business School, makes up around 13% of the U.S. labor force. That seems about right. Okay, yeah. I'll buy that. Maybe it's 100% accurate. I don't doubt. My prediction, Payton, we're all predictions here. My prediction is that I'm going to go as soon as, I'm going to do 2 years. In 2 years, I predict that there will be more middle managers in America, not less.
We'll see. We'll see if they even keep up with the statistics.
I think that this whole, AI job apocalypse thing is way oversold. It's the same. It's kind of, to me, it feels like similar to the crypto bro telling me that, my days of using the U.S. dollar are past. It feels very similar, although AI is definitely more legitimate. But we'll see how that shakes out. That's really good. All right, well, we're out of time, so we got to get moving here.
Yes.
You right? Listeners, I hope you enjoyed a little peek into how we form our opinions and predictions. We'd like to invite you one last time. If you want to reach out to us, it's 251-327-2124. Website is gulfcoastfa.com. There's a calendar button on there. Get with us. 3 office locations, Fairhope, Orange Beach, and Mobile. That's our show for the week. I want to give a huge thank you to my co-host, my son, Payton Null, my oldest son, Payton Null. Great job, son.
Thank you.
All right. Thank you to the show producer. Again, that's Payton Null. Been the show producer for almost the entire time period, which is great. Thank you to our show sponsor. That's Providence Partners and Mr. Jay Stubbs. Thank you to our awesome radio station. That is FM Talk 106.5 out of Mobile. Many thanks to the provider of our show music, as local band Sloth Racer. And as always, my sincere appreciation for all of you out there that have been listening and joining us on this journey. We'd love to be a part of your journey as well. Till we talk again, have a wonderful and productive week. This has been Coasting in Retirement with Josh Knoll. Gulf Coast Financial Advisors, LLC, known as GCFA, is a registered investment advisor offering advisory services in the state of Alabama and in such other jurisdictions where it is registered, filed the required notices, or is otherwise excluded or exempted from such registration and/or notice filing requirements. Registration does not indicate or imply that GCFA has attained a particular level of skill or ability, nor does it constitute an endorsement of the firm by the Securities and Exchange Commission, the SEC, or any other state securities regulator. The Coasting in Retirement radio program serves mainly to disseminate general information, including those pertaining to GCFA's advisory services, together with access to additional investment-related information, publications, materials, and links. The publication of this radio show should not be construed by any client and/or prospective client as GCFA's solicitation to effect or attempt to effect transactions in securities, nor should be interpreted as GCFA providing personalized investment advice or any type of professional advice for compensation wherever this program is broadcast. Any subsequent direct communication by GCFA with a prospective client will be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. Certain information, news stories, headlines, data, charts, graphs, figures, or statistics presented on this radio program may have been obtained from third-party sources that are believed to be generally reliable, but which GCFA may not have independently verified. GCFA does not and cannot guarantee the timeliness, accuracy, or reliability of any such third-party information and undertakes no obligation to update or correct any information that may become obsolete, unreliable, or inaccurate. This radio program also contains the opinions, views, and perspectives expressed by Josh Knoll and any other GCFA representative, which are solely their own and do not necessarily reflect the opinions, views, or perspectives of GCFA as a firm. Such personal views and opinions should not be construed as endorsements or professional advice from GCFA. GCFA makes no representation or warranty regarding the accuracy, completeness, or reliability of any information on this radio program and disclaims any liability for any direct or indirect loss or damage incurred from using or relying on such information. GCFA and Providence Partners are not affiliated, nor are any of their respective representatives.